All right, so the bull run in retail participation in the Indian mutual fund industry is showing no signs of slowing down. Data released by AMFI shows that SIPs are now at record levels. Not just that, mutual fund AUMs too are at an all-time high. So let's unpack what this means for Indian equity and mutual fund industry. We are joined by Swaroop Mohanty, CEO, Mirror Asset Global Investment India. Swaroop, good evening and welcome to the show. How do you read this data? Equity inflow at a 6-month low, but SIP numbers at an all-time high once again. Now, what does this indicate? A lot of profit booking at market high?
No, Kavita, first of all, thank you for having me on your show. Yes, you kind of you said it because whenever the markets are the way they are right now, and there has been a very sharp upturn in the last 1 month at least, we do expect some of the investors to take some money off the table. But what is heartening to see is that while the lump sum investment is seeing that kind of a behavior, the SIP investor is absolutely staying put in the market. We have to observe that the same investor is behaving very differently because, in my portfolio, I would have an SIP, I would have some lump sum. While I would be redeeming from the lump sum side, my SIP continues to grow. And that's just re-emphasizing the long-termness of equity in people's minds. And finally, we are seeing the right behavior of investors towards this asset class at a time when the country is poised to become, a very strong economy in the next 5-7 years or 7-10 years. People who hold equity will, benefit from this journey, and that is what is playing out.
So the number is 14,749 crore in May, as compared to 13,728 crore in April. What pockets are we looking at? Increasing interest in small cap and mid cap, 27th consecutive month where we are seeing a lot of investment coming in over here.
Kavita, the SIP figures are showing a little bit of decline this month. I wouldn't read too much in a 1-month data. It could be due to some other factors of maybe the SIP registrations or the stoppages. We have to read through that data. If this follows up in the next 2-3 months, then we can see a trend. But in first month, I won't read too much. But yes, what you're saying is correct. There's a lot of discussion on the large cap side on its capability of alpha generation. But we hence seeing a shift towards mid cap and small caps among investors, and hence the progression seems to be growing towards the lower market cap in portfolios. And now, two things on this. One observation is the focus continues to be more towards return generation probably than on risk mitigation, because if people stop buying large caps and start buying small caps, I just hope and pray that they are aware of the increase of risks in their portfolios. If they are, there is no issue. But if it is just pure return generation or return chasing, then one has to be a little cognizant of the increase in the risks in their portfolios that is mounting through this process.
Very well, diversification is needed in their portfolio across market caps. But then what is the trend at your AMC? What's the category that investors are looking at?
So I think the trend at our fund has been the same. We don't have a small cap fund, so we can't comment on that. But we've seen some interest in our flexi cap. We are seeing some interest in our balanced advantage, which in the industry is going the other way. The SIP book remains consistent. So yes, the large cap has got some redemption. So it's very much in line with what's happening in the industry. We are not deviating from that trend. The only place where we probably deviated is the balanced advantage. Our ETFs have got flows like the industry, and incidentally in the ETFs also we've seen some profit booking last month. So across board, people are taking off some money off the table, and the good part is they're taking it off at market peaks. I'll be a little upset if they start taking off at the lows in the market, but no harm in taking some money off when the market peak, as long as they buy when the markets go down. And that has been a change in trend in investing in Indian retail investors, at least post-COVID. They have been buying low, and if some of them are selling high, nothing wrong with it.
And the SIPs are intact. One last question. Talking about new investors, what's the trend in tier 2 and tier 3 towns? Anything specific or new that you've observed?
See, I think the trend on SIPs is only getting stronger in those places, though there also the trend is skewed towards small caps. And I just hope it's not the new investors who are coming directly to small caps. That's very difficult to sort of gauge. But the trend of the SIP registrations continue to get stronger month on month from these cities. And that's just the beginning of the penetration of mutual funds across the country. Today, if you see the number of folios being added, year on year, post-COVID is completely different to what used to happen before COVID. So one can safely start concluding that the investment in financial assets is just on the threshold of uptake, and in the next 4 or 5 years, we will see more a shift towards financial assets than the erstwhile fixed assets that was the trend of Indian investors.
All right. With that, thank you so much, Swaru, for being on the show and helping our viewers with this data today. Thank you.
Thank you, Kavita. Such a pleasure always to be on your show.
Same here. Thank you. We move on. Investing in smaller companies can be accomplished in a number of different ways. Each avenue comes with its own challenge and opportunity and unique risk-reward profiles. But something that is not well understood or as proactively followed is the microcap universe of public companies. So what exactly is a microcap company, and why is there so much of buzz around it? Let's understand all of this with Aditya Agrawal, co-founder Wealthy.in. Aditya, good evening and welcome to the show. So let's understand the space, which is microcap and which is actually becoming a favorite of a lot of mutual fund houses as well. But then that's a later part of discussion where we'll get into. Just give us an introduction of this space. What does a microcap space actually mean?
Kavita, for having me on the show. Microcap is essentially, you could look at it two ways. One is the companies beyond the top 500 companies in a stock exchange. Those are often referred as microcap companies. Or you could also look at companies that are, within the sort of market cap of 1,000 to 5,000 crores, right? So those are essentially referred to microcap companies. And obviously, there is a strong buzz about the microcaps. So Nifty has this index called Nifty Microcap 250. So the reason why you see a lot of buzz is because in last 1 year, that index on Nifty Microcap 250 has returned almost 24.5%, right, in last 1 year. So that is one of the reasons why you're seeing so much or hearing so much buzz about the microcap stocks in India.
But then the last 3 year performance has been the index, if we talk about Nifty Microcap 250, has given 56% return. And if we have to compare it with Nifty 50, in last 10 years, the return has been 23% CAGR, of course. And then it's twice the return of Nifty 50. So isn't this space really exciting? At least looking at the data wise.
Yeah, no, I think you used one word, right? Risk reward, right? So you have to be okay with the risk that might come with the reward, right? Because what happens with a micro cap company is that, let's say, for example, if I'm investing in a company called Reliance, right? I have all the data available, balance sheets are available for many years, there are analyst calls, there are analyst presentations, there's so much information available out there. But when I compare that with a micro cap stock or micro cap company, that information is very sparse. So I don't get that much information about that company to really analyze its prospects and its performance compared to its peers, right? So the reward is, of course, is exciting, but the risk is also there because, you don't know so much about that company or that business to really analyze it to the depth.
And also the universe is pretty small, as compared to a large cap, which alone accounts for almost like 66% of the market. Microcaps are like just close to 3%. But then what kind of sector-based companies are we talking about over here? What could they be?
So microcaps are very similar in terms of their sector representation, right? But obviously some sectors dominate. So for example, capital goods is something that is almost 20% of this index. Financial services is another 20%, right? But after that, there's like a whole range of sectors that sort of contribute. So after these two top sectors, which are each 20%, right? After that, most of the other sectors are at 3-4%. So, you have your consumer goods, you have your specialty chemicals, you have your sort of IT services. So all of those essentially then come up as part of the sector allocation. But yeah, the top two are capital goods and financial services.
Are these micro caps to a small cap, because it is still possible to get knowledge about small cap companies and maybe even the analysts cover it. But then are they somewhere closer to small caps?
Yeah, that's a very interesting question. In fact, a lot of the small cap funds today, mutual funds today, right? They also get you exposure to some of these micro caps. So, for example, like I think if I'm correct, Tata AMC small cap fund, their average market cap is about 5,000 crores. So, which means that they have some companies which belong to the micro cap category. So obviously these small funds that are focused on small cap, they have probably done their research and sort of are recommending or including the right kind of micro cap companies in their bucket, which could potentially become small caps or mid caps of tomorrow, right? Because obviously, every company has a journey, right? So every company might start small, but some of those then are able to acquire market share and become big. So I'm sure there are companies in micro cap tomorrow which can become a small cap, mid cap, and maybe a small percentage can also go and become a large cap tomorrow.
Let's say, Aditya, if someone has a longer time duration, which we usually say for a space like mid cap and small cap, one should have at least 5 to 7 or maybe even 10 years. So if one has that kind of a time horizon, you think they have the ability to remain unfazed in terms of volatility and uncertain environment?
I think the thing with micro cap is that, so for example, when you're investing in large cap, right, you at least know that the company is going to stay around, right? They have a proven business model, they have a good balance sheet, right? But in terms of micro cap, sometimes you may not, like there might be companies that are sort of, they lose market position, and over a period of time, they lose the market cap as well, right? So in terms of micro cap, horizon may not necessarily be the only thing to look at, right? But yeah, if you have a longer term horizon, the way at least we recommend is that you ideally have an allocation which is sort of allocation towards large cap, mid cap, and some small cap, right? So because that small cap or micro cap portfolio can give you that acceleration, right? But it can also be a source of high amount of volatility in your portfolio, even if you're investing for long term.
So, do you think instead of buying directly, one should really go through mutual fund route, and that could be through a route of a small cap fund if you want allocation of micro cap in your portfolio?
100%, because as I said, it's very hard to analyze companies in detail. Not enough information is there, and you're rather better off identifying a mutual fund which is sort of works for you, and in getting exposure to small cap or micro cap companies through that.
Specific micro cap funds yet, right, Aditya?
So currently no, but what we are hearing, HDFC has filed a specific micro cap fund, HDFC AMC. But besides that, there is no other micro cap focused fund right now, because I think they probably sort of get stuck with the same, right? That there is not enough information to sort of do stock selection in that space.
But even if one enters this space through a small cap fund, it's advisable not to have that fund as your first ever entry in the equity market.
Definitely not, because if you look at the standard deviation of these funds, essentially very simple, right? If you're a large cap, you will have volatility, or maybe sort of think of it like that, right? That investing is in some extent roller coaster, right? That it goes up and down. But if you are going to a micro cap, then essentially your highs will be too high and lows will be too low, right? So that's too much for a heart to handle, right? So I would suggest that you don't allocate more than 10% of your money to small cap or micro cap space.
So even in the existing small cap funds, typically what's the allocation percentage to a micro cap, Aditya?
It would still be small, right? It will still be small, but as I said, like if their average market cap is, let's say, around 5,000 crores for a small cap fund, then it means that they at least have 20% allocation to smaller or micro cap firms.
Now, even if someone wants to buy directly, what will be a word of caution from your side, and what would be those thumb rules in order to, check and then enter that space?
Yeah, I think if you're looking to invest in stocks directly, uh, if you know that company and if you sort of are, let's say, a supplier to that company, if you're sort of a customer of that company and you've seen that company do well for you, that obviously is a great, you probably have a first-hand knowledge which others might not have. So that probably is, one particular way of looking at it. Obviously, second way of looking at it is that, even if you're looking at micro cap space, you can look at the top 10 companies and see, which are top 10 or 20 companies and see which one of them sort of according to you, have a position or have a product in the market through which they can build, a reasonably strong market share over a period of, next 5-7 years.
All right, so risky space, microcap, if at all you want to have an exposure of it, small cap fund will be an ideal choice, but then see to it that your portfolio is very well diversified in that sense also. Thank you so much, Aditya, being on the show and helping our viewers with this today.
Thank you, Kavita.
Thank you. On that note, we'll take a quick break, and then post that, let's talk about equity mutual funds for senior citizens. We'll be joined by Arun Kumar after this break. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. Now, when it comes to investing in mutual funds, one is often told to start early in life. After all, the sooner you start, the more time you give your wealth to compound over the years. But what about senior citizens? How can they start their journey in mutual funds? Let's understand all of this with Arun Kumar, Head of Research, fundsindia.com. Arun, good evening and welcome to the show. We usually talk about millennials and Gen Zs and, give them a roadmap of how they should start their investment. But what about senior citizens entering the equity space via mutual funds? Too risky for them? Because we've seen times changing though.
Yeah, hi Kavita. Thank you so much for having me on the show. So broadly, if I take a step back and look at what are the major three concerns for any person who is retired, one, it starts with the fundamental thing that this is probably the last large amount that they have, and their incremental salary inflows are no more there. So in that sense, safety becomes the highest priority. So the first thumb rule that most of them have is that better safe than sorry. So there is naturally an inclination towards products which are extremely safe, and they are slightly willing to compromise on the return. So the primary starting point is the safety aspect. But then again, the second part is that you are also taking the money out of your portfolio every year. And then again, you also have this inflation increasing the yearly requirements for you. So net, psychologically, there is also fear creeping in every time you start taking the money out of your portfolio. And if your returns are not accommodating for both the inflation and the fact that you are taking money out of your portfolio. So that is also the second aspect which kind of has to be combined along with the first part, that I need it to be reasonably safe, but at the same time, I can't overdo it because I need my money to grow in such a level that I can adjust for inflation, and also the fact that I am going to take out money almost every year for my own needs, right? And the third part is it also has to be fairly easy to take out the money any point in time, be it some medical emergency, or you don't want it to be an asset class like say land, where it is reasonably difficult to sell and get the money back. So overall, these are the three major trade-offs which any retired investor will have to take. So in that sense, if you really look at it, mutual funds are a good space which can provide a decent solution for all these three problems. And so equities can definitely be a part of the overall solution, where it will predominantly cater to the fact that the returns will be definitely far better than inflation over the long run. It is super liquid, but again, on the safety part, the near term might be a lot more volatile, and they will have to go through temporary falls on a regular basis. But again, the idea is to combine it with far safer debt mutual funds and probably a little bit of gold, so that overall you can combine and build a solution which is fairly addressing all the three, and you take a trade-off which you are kind of okay with. So I think broadly that's the space where mutual funds are getting more attractive for retired folks. And again, equities are not the entire thing, but as a part of their overall solution, it makes a lot of sense.
But then, just to get a perspective, Arun, the trade-offs or the concern that you just highlighted, if I want to compare with traditional form of investment instruments that usually, someone at 60 or maybe retiring would want to consider, what are the red flags? I mean, you've highlighted the trade-offs beautifully over here, which makes it very comfortable, although it has to be a certain part of your portfolio planning. But then if I want to compare these concerns or these trade-offs with the other traditional or more comfortable investment avenues, what would those be?
Yeah, so traditionally, if you look at it, most often than not, you will find people going for FDs as their primary starting point. And then there'll also be some insurance products which kind of guarantee you cash flows after, say, 5 years, or there might be annuity plans which start immediately. But broadly, in these two, you are more or less guaranteed your returns. But again, the trade-off is that the returns are also very, very low, that they are probably just about beating inflation, or in some cases they might be slightly lesser than inflation also. So this is a challenge which most of them kind of realize maybe 5 years down the line or 10 years down the line. So this is predominantly, and probably the other sources, like you have your own home and you get rental income. But again, in India, rental income yields are extremely low. They are around 2-3%. So again, that is also not a great thing. And land or real estate is, again, if you're buying it purely for the appreciation, there's this problem that you can't take out the money anytime, and it requires a lot more due diligence and activity from your side. So net putting all these together, that's the so if you're looking at all these products, the first thing to look at would be like, do you really understand what this product is and where are the returns coming from? Sometimes what happens is we don't ask the basic question saying, how are these returns coming, and are the returns at a basic level that they are able to beat inflation? So first level, where is the return coming from? Do I really understand the product? And is the return at least bare minimal beating my inflation? The higher is the better. But again, I can't put everything into very high return products. The second question would be that, are there hidden charges? And what is the lock-in period for these kind of products? Usually you will find that there are a lot of hidden charges in most of these products. And sometimes the lock-in periods are also extremely long, say 10 years or 7 years. So these two are again, very critical in order to look at it. And the most important part is to also understand the different kind of risks that the underlying product is taking. It might be into pure debt like products, or it might be into equity. But the point is that the underlying is usually not very clear. So you need to really go inside and then check where is my money getting invested, and based on that kind of take a call on what is the underlying risk. Now, once you put all these three things together, most of the red flags you'll get to know most of the red flags. And if the returns are insanely high and it looks too good to be true, then you always need to be much more careful. If somebody says guaranteed, but the returns are insanely high compared to an FD, then you need to be really, really careful, because it means that there's a lot of risk involved. So overall, putting it together, understand where the returns are coming from, and are your reasonable return expectations, can it beat inflation by a decent margin? And the second level would be, what are the risks involved? And the three is that, what are there hidden charges, and are there any kind of lock-ins, or how easy is it to take my money back if required? So I think if these three are broadly checked, I think you should be good to go.
Arun, 60 cannot be the age when you want to start out in equity through mutual funds, or you think that's doable?
See, I think, generally we have seen that people who have already got an experience with equities, probably in their 40s or 50s, are a lot more comfortable when it comes to building slightly equity. I mean, they're obviously not going to be very heavy on equities, but at least most of them will kind of at least have a 40 to 60% equity kind of an So they're comfortable with equity exposure. But for somebody starting out equities for the first time in their 60s, I think most of them are kind of taking an approach of testing waters, where they just want to try, because they kind of realize that, hey, there is a problem in terms of I'm not able to generate decent returns which can help me beat inflation, because I can't have everything in fixed income kind of product. So I need one product which can give me that kicker. But again, the caveat is that it is very, very volatile. The ups are easy, but the regular downs are a little more difficult. So we have seen that people who are new are mostly testing waters with very small amounts, and then eventually, as they build confidence, they kind of build it over a period of 5 years. But my sense is, if you are retired, you will at least bare minimal need anything around 40% to 60% in equities, so that you can build a reasonably good solution which can account for inflation, and also address the fact that you are going to take money out of that. But again, if you have a very, very large amount of money, then this equity allocation you can completely do away with it. But I'm assuming somebody at 25 times or 30 times the yearly requirement that they need, if that's your portfolio that you're talking about, then I think it makes a lot of sense to at least have a bare minimal 40% into equity. Otherwise, like you will otherwise the compromise has to come in the form of lower spending that you do. So net, it's all the trade-off. But my sense is if you have a comfortable 25 times your annual requirement, then I think 40 to 60% equity is a good enough number to start building your portfolio.
To start building your portfolio even at the age of 60. But then let's understand the entire process of SWP now, which is a fantastic feature that mutual fund actually allows. So if someone has a good amount of corpus that they've counted in and planned really well, but then invested in traditional investment instruments, and at the age of 60 want to take a route of SWP through equity mutual funds, how can they do it? What should be the homework?
Right. So the way we kind of approach this problem is fairly break it down into simple parts. The starting point would be that you at least have, say, 25 times to 30 times of your annual, let's say you need X as your entire yearly requirement, at least have 25 to 30 so that you can start building a decent portfolio. The higher the better, but bare minimal 25 should be a good enough starting point. Then the second question would be that how much do you want in equity and how much do you want in debt? The logic being very simple. The more you have in equity, the better will be your long-term returns. But again, your ups and downs that you will see over a 1 year, 2 year time frame will be far, far higher. So I think bare minimal 40, 50, 60 is a good range to start with. So the second point would be figure out what is your split between equity and debt. If required, you can also add 10 to 20% into gold, but let's keep it simple, equity and debt. So maybe say 50% equity, 50% debt. And then the third level would be fill your equity buckets using either passive or you can use active funds. And then debt, again, you keep it extremely safe. You keep it to very low duration products and super high credit quality funds. So mostly stick to the categories like short-term funds or low duration funds. So once you put this together, you let it run for 1 year. And after 1 year, you take out the yearly requirement that you need and you put it into a liquid fund and make sure that an SWP starts from the liquid fund. So net, what happens is every year end, you take out the money. And the key question is, in what proportion should I take? Should I take more from equity or should I take more from debt? This is where the beauty of rebalancing comes, because you've already started with 50% equity and 50% debt. Just take out the money in such a format that your 50-50 ratio kind of more or less remains the same. So which means what happens is that every time equity markets are doing extremely well, automatically you end up taking more money from equity and lesser money from debt. And let's say equity markets have fallen by say 15%, 20%, then you end up not touching your equity, but you end up taking more money from your debt side. So overall, and then you put it into your liquid fund. And then from there, anyway, there is an SWP, which is automatically set. So broadly, if you look at it, you will hardly need to spend say 1 to 2 hours. And once you get the fund selection right, it's mostly a once in a year activity. So broadly, the starting point to build it might take a little more time, but once you build it, it is just once a year activity and everything else can be automated. And as a good practice, you can always have 2 to 3 years of your money requirement in an emergency fund, mostly in a very, very safe liquid fund, or you can also keep it in your bank FDs. But this can be a good practice. So overall, once you put this together and combine it with an SWP in that liquid fund, then I think the solution can work well. But for some people who want to keep it really simple, you can directly look at products like balanced advantage funds or hybrid funds, and then directly set up an SWP out of these funds, which is a little more simpler. But again, the small nuance is that sometimes even when the market falls, you might be forced to take a lot more money from equities because you don't have control over where you're taking the money from. You're only taking it at an aggregate level. But again, this is a fairly simple solution. But if you want to make it a little more nuanced and you want to have a little more control, the first approach can work. But again, as I told, once you combine it with SWP, it's more or less like an automated solution for you with maybe 1-2 hours of work probably every year when you rebalance.
Last question, because we're talking about senior citizens or retirees, we cannot miss the pension plans offered by insurance companies. No way we can compare it with equity, but then there is a lot of trust in insurance-based investment products. Your comments on it?
Yeah, see, again, it's a fairly simple concept that anything that is guaranteed through these annuity plans, it is very, very comfortable for most investors. But again, because the risk is minimized there, you will also find that the returns that you can generate from that is not significantly over and above inflation. Mostly it will be slightly above inflation, or in fact in line with inflation. So the key point would be that anything that is really extremely safe and more or less kind of you are reasonably sure what is the return that you get, this will generally be on the fixed income side, or let's say these annuity products. And the compromise that you take for the safety is on the return front. So my suggestion would be that while you can have one part of it which will give you that safety angle and the emotional comfort, you will definitely need to have some bit of equities, because otherwise to outperform or to negate for the effect of inflation, and for the fact that you are also going to take money from your portfolio and you don't have inflows. So I think equities are one of the best asset classes which can negate for this. But again, the caveat is that every year mentally you should be prepared that there will be a 10-20% fall in your equity portion. It's like last 42-43 years, you've seen that every year there's a 10-20% fall, and once every 7-10 years there's almost like a 30-40-50% fall. So this is like what you've seen from history. So at least this should be a part of your base expectation. Now for this, to compensate for this, you have the safer the annuity products, or the FDs on the other end, or probably debt mutual funds on the other end. So the idea is to combine both of these, which will ensure that you are able to handle the volatility of equity and get the long-term returns, and at the same time have safety of the fixed income, but you are okay with that return compromise you take on this. So it's a trade-off that you finally take.
All right, so that's a lot discussed about senior citizen entering equity at the age of 60 or even post-retirement. Thank you so much, Arun, for being on the show and helping our viewers understand this today. Thanks. On that note, we'll take a quick break, but then post that, let's get your financial portfolio queries answered by Anil Rego after this break. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. There are a plethora of funds available in the market to invest your hard-earned money, but how do you assess which is the right fund for your portfolio? What are the criteria that one should look at? To help you navigate through this maze, we have on board Anil Rego, who will founder CEO Right Horizons, who will help us understand what should be the changes made in the portfolio. But then also, if you want to send us your queries, you can WhatsApp us. Our WhatsApp number is 865-797-4571. You can also email us your queries on themoneyshow@etnow.tv. Hi Anil, and good evening. We have Dr. Vishwas on the line with us. All right, we don't have him yet on the call, but then let's take up his question. He wants to invest 5 lakhs lump sum in small cap funds and for long term, and over here he specifies 5 years. That's the time horizon he's talking about. He wants to know when is the right time to invest in a small cap fund for the time period of 5 years, and for how long should he be invested, and Axis Small Cap, Nippon Small Cap, PGI Mid Cap, Parag Parikh Flexi Cap, Quant, ELSS, ICICI Nasdaq 100, SBI Gold Fund, HDFC Short Duration Fund. Okay, so let's just talk about dividing this 5 lakh and the kind of timing that's needed to enter the market with this amount of money.
Sure. I think first of all, we must keep in mind that small caps are the highest risk. Okay, so from that perspective, it can also be volatile. So you need to keep it within the overall exposure that is appropriate for you based on your own risk profile. So you need to, look at what is the asset allocation overall and what is the amount that, say, you would be okay with, putting into small cap funds. Because from what I see, he has a few small cap funds already there. So coming back to, the funds that he has mentioned, okay, broadly, I think he's chosen the funds reasonably well. The only fund that is possibly sort of underperformed right now is, say, the Access Small Cap Fund. And if this is a fund that he holds, then it may make sense to move to another fund that he has mentioned there, which is Nippon Small Cap Fund. So that is something. The other is, I would avoid doing, say, ICICI Nasdaq fund, the Nasdaq 100 index fund that he has. Okay, so and possibly move it into one of the diversified equity ones. Now coming back to this, that he wants to invest 5 lakh of rupees, and he wants to do it in a small cap fund. Yes, I think one has already captured some of them. Ideally, now is not a bad time to invest in small caps, because based on our evaluation of market, I think ideally April would have been the best time, but I think we are in the early stages of a slightly longish, rally in our view in small cap funds. So I think PGIM mid cap can be looked at by him if he wants to just monitor Nippon small cap. I think is a good fund to do. Ideally, one can keep it across. If it's 5 lakhs, it depends on what is the size of his portfolio. Keep about overall 8 funds or so. Don't go too many beyond 8 funds. And if that's the case, then and the portfolio size is larger, then you can have it in a single fund. Otherwise, maybe he can split it into a couple of funds.
Recommendation for Dr. Vishwas, but then we move on. We have Mr. Johnson from Kerala on the phone line with us. Hello, good evening, sir. How are you doing? Mr. Johnson? Can you hear me? Hi, good evening, sir. Thank you so much for sending us your query. And you have about 20 lakhs you want to invest in mutual funds for the period of 5 years, right? Okay, I don't think so. I don't have him. I don't think I have him on the phone line. But then, since we've just mentioned the query, let's just answer this question for Mr. Johnson also. He has 20 lakhs and he wants to divide this money or investment into 3 years, 4 years, and 5 years, and he wants to keep it in 2 to 3 funds. What's your recommendation?
Yes. So first of all, I think it's keeping in mind that he's a retired person. I think it makes sense to have a moderate or moderate to high risk level, depending on the other assets that he has. Right? So that's the first point from an overall level. The second is in terms of what are the funds that he can look at. Yes, if he's looking at small cap funds, then I think 4 to 5 years is a good time frame that one needs to look at it. But possibly one could sort of avoid them. So what I would suggest is do a combination of these, which can be large cap, which can be ICICI blue chip in the large cap category. You can look at HDFC FlexiCap in the FlexiCap category. And apart from the pure equity ones, I also think that maybe 50% of his portfolio can be in hybrid funds. One of them can be an aggressive hybrid, like an ICICI Blue equity and debt aggressive hybrid. And to be conservative, I think he can use a balanced advantage fund. Now, a balanced advantage fund basically has a dynamic asset allocation between debt and equity. So as markets go up, the fund moves into debt. As market comes down, it moves into equity. So it counters the risk very well. So if he requires monthly income and stuff like that, the HDFC Balanced Advantage Fund in the BAF category, Balanced Advantage Fund category, I think is one of the better ones to invest. If he wants to be more conservative, then he can expand this. And especially if he requires some sort of regular or monthly income, I think this is a good fund to look at in that category.
All right. We have Himanshu online with us, Anil. And hi, good evening, Himanshu. How are you doing today?
Yes, fine, ma'am.
Thank you so much for sending us your question. We have your portfolio. Is there anything that you want to add?
Yeah, just what I mean to say that I have a SIP of 1,50,000 as I have, disclosed with you on your WhatsApp chat.
Right.
I just want to know that whether it's correct, the combination is correct of the various funds which I have, or do I need to make some changes in it?
Okay.
Because, I don't have any goal. It's just for my financial freedom.
Okay.
And I have sufficient funds to needs and everything.
Okay.
So it's just for saving purpose and having financial freedom.
Fantastic. And thank you so much. You've really planned your portfolio really well, and you are on the path of financial freedom, I guess. In fact, Anil will do the checkup on that. Anil?
Yeah, definitely. I think so. First of all, congratulations to Mr. Himanshu. I think he has done a great job in, spreading out his investments. Also, not too many funds, okay, but, maybe what is it that he can tweak around among the funds? See, he has something like I say, Nifty 50 index fund, which I think is a good thing to have. Okay, so then he's also broken it up, some of the funds, emerging blue chip, which is large and mid cap. He has a couple of in fact, 3 small cap funds. One is Edelweiss, Cantor, Beco, and also Quant Small Cap. Okay, so among these, I think what I just wanted to highlight is Quant Small Cap has been a very aggressive fund. Okay, so you need to keep that in mind. So I wanted to highlight, so I actually put it on watch for you. So depending on what perspective, if you are willing to put aside some money into really high risk, then this is something that we can do. So if you look at risk measures like standard deviation, etc., it's much higher for this fund. And interestingly, this fund also did well because it participated in the Adani stocks. So it did see volatility, because of that as well. So my point is that is one fund that, just need to keep in mind that is a high risk fund. The other fund which he has, which is a mid cap fund, I mean, 2 of them, PGI mid cap and White Oak mid cap. I think PGIM is a very good fund and it's been consistent and doing well. But the White Oak mid cap is something that, I think one can sort of exit, okay, and possibly go and put that back into PGIM mid cap.
All right, we move on, and the last caller is from Punjab, Abhijit. Hi, good evening. How are you doing?
I'm good.
Thank you so much for sending us your question. And you want to invest 80,000 per month, and you want to reach the target of 10 crores in 5 years, right? 5 crores in 10 years. I'm sorry, it's the other way around.
7 years, will it be possible?
All right, that's a very substantial amount of investment, Anil.
Yeah, definitely. I mean, I cannot compute the numbers offhand like that, but I think you just need to look at it from a future value at say 12-15%, depending on the risk that you're willing to take. If it comes to that figure, then that is good. Okay, but the whole point is having an objective in mind is a good thing to do. So I think it's good to look at it and have an aspirational one, and possibly if you are falling short of it, you can review it every 2-3 years, and possibly on a yearly basis increase it in line with inflation. Now, so if you are find that you're not able to achieve that goal, then you need not be disheartened, and just keep in mind that you can increase it with inflation and keep on increasing your SIP. So that is one thing. The other aspect is if you want some of these higher numbers, then possibly you have to take higher level of risk, right? So if you you can do that in a combination of say multi-cap funds, and you can do a combination of large and mid caps and also mid and small caps. So I think if you just go back and spread it out across all of them, possibly depending on the risk level that you would like to take, you can see whether you want to do a higher percentage of mid and small cap funds. This next maybe couple of years, I think is going to be good for mid and small cap funds.
So the right kind of diversification, I guess, is needed for that. On that note, thank you so much, Anil, for being on the show and helping our viewers with their financial portfolio today. And before signing off, I'm going to leave our viewers with our WhatsApp number and email ID where you can send us your mutual fund portfolio related queries, and we will get it answered by our experts on the show live. Thank you so much for watching. Goodbye.